Hi, everyone. I'm just going to give a moment for the rest of our presenters to join me on stage. Thank you all so much for being here. All right. Looks like the gang is all here. So for those of you who do not know, my name is Julie Demers. I'm the Executive Director of the New Hampshire Tech Alliance. I'm thrilled to have three incredible people joining me on stage today to talk about developing a charitable giving strategy. Most of you who are tuning in right now and joining us live are probably not aware of the fact that the New Hampshire Tech Alliance recently launched a 501c3 supporting charitable organization. And the goal for this is to really support the advancements of our programming that supports diversity, equity, inclusion, programs like CS4NH, our Tech Women, Tech Girls initiatives and programming. So our charitable arm will also continue to help us provide free complimentary programming for budding entrepreneurs. So we are very exciting. This has been a journey for us in learning how to think philanthropically. And as we sort of started out on this journey, we thought, this might be really nice for our members to come along and learn with us as well. So keep an eye out for future announcements and opportunities to support some of our charitable efforts. There'll be more news to come in the coming months. So today, to sort of kick off that and celebrate things that are coming in the future, we have three outstanding individuals who can help you better understand different aspects of charitable giving. I encourage all of you right now, you're probably looking at the chat on your screen, but go ahead and ask any questions that you came here with today in advance. You don't have to wait for the Q&A portion of the program. Any questions that you ask, just drop them in the Q&A, and that will help inform what our speakers hone in on during their own presentations today. So I'm pleased to introduce you to our incredible lineup to help us better understand charitable giving and how we can leverage our own success to make an impact. So first and foremost is Pete Lachance. Pete is a partner at Altair Group, a full-service CPA firm located right in Bedford. But most importantly, I think at least in my world, Pete has been an active board member, our treasurer for more than 6 years at the New Hampshire Tech Alliance. So he has been instrumental in the growth and the evolution of the organization. And has really played a critical role in getting our C3 charitable arm off the ground, which is no easy task. So you'll hear from Pete today. We also have Melissa Olszak. She's with Lake Street Advisors. She's a member of their firm's senior management team, and she particularly enjoys the area of wealth management and helping families meet their overall objectives in terms of having an impact. This won't be the only opportunity that you have to hear from Melissa. She'll be joining us in June for a webinar as well. So if you like what you hear today, join us in June as well. And Rick Peck leads the New Hampshire Charitable Foundation, probably a man who needs no introduction for those of you tuning in here today. So he leads the foundation's philanthropy and donor services team, aspects of development, donor engagement, and donor services. And I think I've had Rick on speed dial as we've navigated this process as an organization. So I cannot begin to express how much I've valued his insight and knowledge around literally every area of charitable giving. So I hope that you will all have some wonderful takeaways today. I'm thrilled to be able to introduce the panel to you. And again, drop those questions as they come. It's meant to be very casual, informal, and we hope we can provide some valuable information today. Just so you all know, the red record button means this be available after today. So feel free to engage. You don't have to vigorously be taking notes. You can check it out on YouTube immediately after this. So thank you all so much. So with that, I'll turn that over to Melissa.
All right. Thank you, Julie. That was a nice intro and a good background for people as to what we're going to cover today. So I'm just going to move through the first couple of slides. You did a nice job on introductions, and then giving us all a little bit of background. So what we're looking to cover today really are 3 items, and they're really meant to provide some kind of basic background for people who are interested in charitable giving. The first part is just updates in charitable giving, and that's really 2 parts within that. So the first kind of sub part is talking about some tax changes that have happened in the last couple of years, and some opportunities for people as they think about maximizing charitable giving and tax deductions. And then the other piece within the kind of update is just trends in giving. So a lot going on in the world right now, a lot of areas where people have a lot of interest in helping. So we'll spend a little bit of time there just giving people a sense of what the trends have been last year and this year. The second part of it is really the ways to give, and we've broken that section into 2 parts as well. So one is just thinking about the different structures that people use to give, and what's most efficient depending on what somebody is trying to accomplish with their giving. And then the other part of it is what assets make the most sense to give, again, depending on what somebody's trying to accomplish, whether that's cash or whether that's investments that they own. And then the last piece, which we think is very unique to this group and this audience, is really focusing on opportunities that are unique to founders and business owners to try to maximize their giving. So that's our plan today. And as Julie said, if you have questions along the way or after, we encourage you to ask those. And we'll plan to include all of our contact information at the end so that people can reach out afterwards if they'd like. So I'll turn it over to Pete, and he'll go over some of the tax updates.
Thanks, Melissa. So there's actually been quite a lot of changes. Obviously, that's an understatement the past year since COVID kind of hit. But even before that, there were some changes that people need to be reminded of with respect to charitable giving. So lots of new opportunities available. So back in March, the CARES Act was passed right after COVID hit. And there's really 3 things that we want to remind people if they weren't already aware of it. One is everybody can now do $300 of cash contributions. And this is regardless if you itemize or not, you can do this. So that's a nice benefit because a lot of people don't itemize anymore. And then in 2021 only, you get it's actually $600. So both, if you're married, filing joint, both spouses can do a $300 cash charitable contribution. The second is, and this is more applicable, I think, to significant charitable contributions, is in the past there was a 60% limitation. It was an annual limitation. You can only deduct 60%. So for example, if you can only deduct 60% of your income. So for example, if your income was 100,000 and you donated that whole 100,000, you were super charitable. In the past, you can only deduct 60,000 of that, and the remaining 40,000 actually wasn't lost, was carried forward and could be used in future years. Well, for 2020 into 2021, that's been removed. So now you can deduct the full 100,000. And then lastly, corporations, these are big, I think corporations for the most part, can deduct up to 25% of their taxable income. In the past, that was 10%. So those are the recent changes as of the CARES Act. On the next slide, so the Secure Act was actually put in place prior in December of 2019, which seems like forever ago. But there are a few things that Secure Act put into place, and some of these are very impactful. So RMDs, not charitable related, but there is some correlation here. Required minimum distributions, RMDs, moved from back to age 72. So that's when you could start to take them. However, what's really nice is there is an ability to kind of, instead of taking your required minimum distribution, recognize that an income, you could actually contribute that right to a charity. What's nice about that is you don't recognize the income at all. And for some people, a lot of clients that are very well off don't actually need the income from, or nor the cash from an IRA. And so the ability to kind of bypass that, and even though they have to take the money, they don't have to recognize the income and can give it right to charity. This is also nice if you don't itemize as well, because if you were to do a charitable donation, you didn't itemize, a lot of times you don't get any tax benefits. So a QCD is what that's called, the qualified charitable distribution. It's a really nice benefit if you're a non-itemizer and if you don't need the cash from an IRA. So those are just kind of some quick updates on what's happened over the past couple of years. And Rick's going to go next on giving trends.
Great, thank you. So yeah, when the three of us were planning this presentation today, we thought it would be a good idea just to give you a high-level overview of the giving trends as of last year. So Fidelity Charitable did a survey, did a study, and I'm just going to walk through some of the statistics with you. So as you see in that first one, about 80% of donors reported more concern for health and human services organizations. No surprises there. During a pandemic, we have seen the same trends at the New Hampshire Charitable Foundation. 50% of donors are also concerned about organizations that work in other fields like the arts and environment. So of course, the arts have suffered greatly over the past year, but it's interesting to see how people pivot toward other causes as well. So more than 40% of the donors report choosing to continue supporting the same organizations they have in the past. So there's great loyalty there. 4 out of 10 people, 4 out of 10 donors will stick to the organizations they supported in the past. And only 25% of donors reported they will give to different organizations as a result of the COVID-19 pandemic. However, that's still 25%. There's still donors out there who are willing to look at other organizations. So it's the importance of these nonprofits to advertise what they're doing. And up in the corner there, the 2 circles, 25% of donors plan to increase their donations. And one would not necessarily think that was going to happen during a year of a pandemic, but that shows that people are charitably inclined, want to help. And 54% of donors plan to maintain their giving levels. So it's very encouraging. People didn't overall, either they're going to increase or maintain their levels of giving. One didn't know what was going to happen a year ago today, and we found that people were remarkably charitable. So next slide, please. So Pete, Melissa, and I thought it would be good also to focus in on local resources. So we just used the New Hampshire Charitable Foundation as an example of an organization that established a Community Crisis Action Fund, a COVID-19 response fund, to help respond to the needs in the community as a result of the pandemic. So we had $4 million donated to the Community Crisis Action Fund by many different people. And what you don't see in the slide, we also had an additional $6 million donated by an out-of-state philanthropist named Mackenzie Scott, who you might recognize had given $4.1 billion away last year to institutions in need. So we were fortunate to receive $6 million of that. So just to give you an example of what grant making might look like in a crisis, early childhood, emergency childcare, lots of people obviously needing childcare during the pandemic. Food insecurity, that shouldn't surprise you. People in need of food when they're losing their jobs or losing some sort of financial stability. SUD stands for substance use disorders. So people who would need assistance with substance use disorder issues, individual assistance, grants to help with that. There were some racial equity projects that we funded, not surprisingly with George Floyd's death. A lot of focus on that, and we were stepping up to help in those types of ways. Also, multi-year community grants. Those were grants that were just given that sometimes were fast forwarded. If we were going to give a grant over 3 years, we fast forwarded and started to accelerate that. And then regional responsive grants. So just helping with the local level, being responsive, being flexible. And then just something at the last bullet there, telehealth. Telehealth was something that was huge last year. People taking advantage of that, mental health, and other types of ways to deliver telehealth. So there was support for those types of things, and then just some information at the bottom about how to support the organization or support that particular fund. But we learned a lot about how to be responsive during a pandemic. Learned a lot about strategy. Learned a lot about flexibility, and we were not unique. So next slide, please. There were some national resources that we just thought we'd put out here for you. TPI, the Philanthropic Institute, is based out of Boston. Very good. If you were able to click on these links, or we can send them to you afterwards. Very, very rich and robust information on how to respond to the needs during the pandemic. Arabella Advisors, also helpful, thinking about things like sustainability and other types of issues that also very robust, lots going on in that particular site. Fidelity Charitable was super helpful, putting about 600 different COVID-19 response funds on a map that people could literally zone in and click on, and if they wanted to help in their local towns or cities or regions, they could do that, or they could just choose to look at the whole map and say, here's different ways that we can support across the United States. And then Schwab Charitable did something very similar. So lots of resources out there on a national level and a local level for people to choose from. And with that, I think I'm going to hand that back to Melissa.
Yeah, so the next part of the presentation that we want to talk about is just the ways that people can give. So the first part of this is just the different types of vehicles that people can use. Some of it is as easy as just using your checkbook. And then some of it gets a little bit more into whether it makes sense to set up a special account called a donor advised fund to remove some of the inefficiencies of the checkbook giving. And then kind of the further you go on the spectrum, there's entities like a private foundation that people can use. I think, and in our experience working with families, we spend a lot of time with them working on if they're philanthropic, what their objectives are and what the best ways to accomplish their objectives are. Tax usually is one of the components, but beyond tax being a driver, it's also really the impact that they're looking to make. So, and that will definitely impact what type of entity makes the most sense to use, because some entities have some restrictions where others may be more flexible in certain areas. So it's definitely a lot to consider at the beginning, and it doesn't have to be kind of set it and forget it. You can evolve your structure as your needs and your objectives change. So you could start with a donor advised fund and then eventually end up with a private foundation and end up using both. And there are more entities than just those two that you could also use. Again, really driven by what impact you're looking to make, what assets you have to give, and really what the overall to accomplish everything. So the first item within there that we'll talk about is checkbook giving. So this is the most common. It's easy for people, even though I don't know how many people necessarily use checks anymore as much as go online. But in any event, it's taking money out of a checking or a savings account, giving it to your charity. Very easy, but we think it's pretty inefficient from a tax standpoint. One, because it requires cash. And usually in order to get the cash, you either have to have income coming in or wages coming in of some sort. Otherwise, you might be forced to sell assets that might be generating a gain. And we'll talk about that later, ways to optimize that. So it's usually not super efficient from a tax standpoint. And from a record keeping standpoint, it can be a bit of a hassle. So any charitable donations that you make that are over $250 require a receipt, and you need to keep track of that. So if you get audited by the IRS, and I'm sure Pete's been through it, I've been through it with some clients, the IRS will ask you for receipts from the charity that say the date, the amount, the name of the charity, and that you didn't receive any goods or services in exchange for your donation. And then beyond that, they'll sometimes ask for bank statements or credit card statements to actually prove approve the donation. So you can imagine if you're writing, 50 different checks, it can be a lot of time to make sure that you have all the records in the event of an audit. So if you want to get a little bit more efficient, account that you can set up at an organization like New Hampshire Charitable or Fidelity or Schwab, or other community programs like the Boston Foundation. There's lots of them. It is a donor advised fund. So what that is you're working with a large public charity, and you work with them to make a donation to them. And then in exchange, they basically set up an account where you have rights to make grants out of it. Legally, it is their money when you do that. So legally, while you have grant recommendation rights, they do have basically final decision making as to whether the grant will be approved, and whether the recipient that you're recommending is an approved charity to receive the money. But the nice thing about it is, they do all the management of it, so you don't have to worry about doing a tax return, paying taxes out of it. They'll provide investment options that you can choose from. And it just is a nice, easy way. Most of the grant options that you have, you can just go right online, their website, make a recommendation, and then they will generally always take your recommendation and make the grant that you're asking. The other nice thing about it is when you make a donation to the donor advised fund, that's when you get the deduction, because they are considered the public charity. So if you're trying to be smart about when you want to take the deduction from a timing standpoint, but you're not quite sure what final charity actually you want to give to, you can make a donation to a donor advised fund in December and then let it sit in the account until you actually decide which charity you want to give to. So it's good from a timing standpoint. It's also good from reducing the number of receipts that you need to collect, because you really only need the one of when you fund the DAF, and you don't need to worry about any receipts for any of the grants that come out of the DAF. So it's pretty easy. Almost all of our clients who have charitable intentions use DAFs just because they are so easy, and there are low minimum account balances, and as I mentioned, kind of no need for annual tax returns or anything like that. And the other nice benefit is you can make grants that are anonymous, which in some cases donors really care about maintaining their privacy. So that can be another important difference. The next item is a private foundation. So we often see this when clients have larger charitable entities that they are considering. So it might be, you might see this if it's, kind of 5 million, 10 million, or something larger than that. And oftentimes, probably the two biggest reasons why we see it is a client may want legal control over the funds. So with a donor advised fund, it truly isn't yours legally. With a private foundation, it is the foundation, and you can have more kind of legal control over it. The other item is investment. So with the donor advised fund, you do choose off of their platform, or in some cases they'll let you hire an investment advisor, and you can work with the investment advisor on the program. With a foundation, it's broader. So in some cases with large entities, that can be something that's a little bit different. The other piece here is, again, for larger organizations, you can have staff, including family, and you can pay some expenses for those staff. And then there is some greater flexibility in some international giving scholarships compared to some other structures. This says that it's designed to exist in perpetuity and are passed down through many generations. That is typically the design. Usually families are thinking about it as part of their legacy when they set it up, but it doesn't have to be. So families really can have some flexibility in designing how long they want the foundation to last, how they want decisions to be made. They really can get into kind of the governance structures that make the most sense for what they're trying to accomplish. in order to have the additional kind of legal control and also the higher flexibility in the investment program, you do take on here more of the annual compliance. So this one does require a tax return. There are specific rules of what private foundations can and can't do that you need to be mindful of. And there is a small excise tax. And even though it's called a private foundation, there actually isn't a lot of privacy, because a foundation has to file its 990 annually, which shows what donations have gone into the foundation and what grants have come out of the foundation. So there isn't a lot of privacy, but in cases like that, we have seen clients have both a private foundation and a donor advised fund. And that way they can have a grant made from the foundation to the donor advised fund and still keep the privacy that they might be looking for, if that's important for the family. But it is more ongoing administration that you'll be taking on if you decide to go with the structure. So here on this chart, and there's a lot of charts, out on the web, we've included some resources here. This just gives you a very high level snapshot. There are definitely more nuances as you're considering what structure makes the most sense. And as I mentioned earlier, these are not the only two structures. There are other structures as well to consider. But just as a quick snapshot, you can see that there are some tax differences in terms of the deduction for donor advised fund versus a private foundation, favoring the donor advised fund. There is an excise tax on the private foundation where there isn't on the donor advised fund. You're kind of outsourcing more of the management and the accounting to the donor advised fund sponsor, as opposed to taking that on directly with the private foundation. Some differences on insurance. There are also some differences on grant payout requirements. With the foundation, you are required to do at least 5% of the foundation balance annually. And with the donor advised fund, because it's a large public charity, they as a whole need to make that 5%, but they don't require their donors to do that, or many of them don't. There might be minimum amounts instead of the 5% that they need to meet, kind of every year or every other year. So there are a few other differences, and it's definitely worth looking into what makes the most sense if you're thinking about setting up structures. And then we've included some additional resources, which, as Julie mentioned, this will be recorded. So a few here is the National Center for Family Philanthropy. Definitely a website that has a lot of information about each of the options that we talked about. The National Philanthropic Trust, and then we recently wrote a blog and have it on our website if you're interested in getting into a little bit more detail and comparisons. So next, I'm going to pass it to Rick, who will talk about the different assets instead of the different structures that people can give.
Thank you, Melissa. So yeah, just talking about leaving IRA assets to charity. Pete talked earlier about a technique. If you're 70 and a half or older, you can take up to $100,000 and move it directly from your IRA to your favorite charity or nonprofit. $100,000, up to $100,000 per person per year. And this is just some other ways that we're going to name as well. So you can name a charity as a beneficiary to receive your IRA assets, because as we know, a lot of IRA assets, traditional IRA assets, are tax deferred. So if you don't want to make donations from your retirement assets during your lifetime through a qualified charitable distribution or otherwise, you can consider naming the charity as a beneficiary. Very tax efficient way to do that. So just going through the bullets there, your estate must include the value of the assets as part of the gross estate, but will get a tax deduction for the charitable contribution. So that can be used to offset your estate taxes. The full amount of your retirement account will directly benefit the charity of your choice or charities of your choice, because charities do not pay any income tax. So it's a very tax efficient way to help your favorite nonprofits. And then you can have the opportunity to support an organization or many organizations as part of your own legacy. One of the things we do at the foundation is we create what's called a memorandum of understanding. So money could be directed over to the New Hampshire Charitable Foundation, But then we set up something where the money could then be dispersed to multiple different nonprofits in multiple ways. You could set up different types of funds, a scholarship fund, a field of interest fund that can support different nonprofits, and a designated fund. These are different types of funds that can be set up through a memorandum of understanding. So the money can be just sent over to the New Hampshire Charitable Foundation, and then we can disperse it to your favorite nonprofits. The other thing I'll mention too, as an add-on to this slide, is regarding the Secure Act. IRAs for non-spouse beneficiaries could only pay up to 10 years and then stop. So after 10 years, the IRA has to fully exhaust. So an alternative for some people is to take the IRA and name a beneficiary. For example, could set up a testamentary charitable gift annuity or a testamentary charitable remainder trust. So these are ways to be charitable, but also turn on a stream of income for somebody who needs or wants a quarterly stream of income for the rest of their lives or for a set period of time. So it helps to replace that income that somebody wouldn't be able to get because of the tax law changes. So that's just a way to be charitable and also continue to receive a stream of income. So next slide, please. So just wanted to talk about ways to give. Again, donating appreciated securities. Cash is usually king. Lots and lots of people donate in cash, but we always want to put a spotlight on other ways to give, non-cash assets. So donating appreciated securities. This can be securities that are highly appreciated publicly traded securities like Microsoft or something like that, or it could be closely held stock or privately held stock. But whatever the situation is, if you have capital assets that you've held for more than 1 year, like stocks, you can donate them and wipe away any capital gains that would be associated with those particular assets. So there's a full value of whatever that value is of the stock when it's donated. It's all pre-tax. There's no taxation associated with it. So 100% of that value goes to your favorite nonprofit, avoiding long-term capital gains taxes that you might otherwise owe. So it's a good way to dispose of those assets if you're afraid of selling them or don't want to sell them. And then and you can possibly subtract the full value of those assets on your tax return as a charitable gift. And Pete would tell you that if you can't do it all in 1 year, you could probably carry that forward up to 5 additional years. So lots of different possibilities there. And again, not on this slide, but there are other types of ways to give, like real estate or royalties or tangible personal property or life insurance. These are all other ways to give beyond the scope of today's presentation. So in other words, lots of other things to consider outside of cash. And with that, I think I'm going to hand it back to Pete.
Okay, so yeah, you know, one of the points I want to make and kind of leads into my slides is, you know, generally the tax benefits are not one of the main reasons people donate. And but what people need to realize is there are very smart ways that you can donate that produce even more for the charity. And that's really what the next two slides kind of lay out. To tell a quick story, I had a client who owned their own business, privately held, you know, a few shareholders, sold out and was very charitably inclined and wanted to donate a lot of their proceeds to charity. And we worked with them, and instead of donating, selling the stock and then donating the net proceeds, it was much more, one, tax efficient for them, but also the charity ended up getting a lot more by donating their stock in the company before the sale. So that's an example of person didn't care, like, I just want to donate, and let's do it in a way that really produces a win-win. So this slide basically lays that out and continues what Rick just said about you have an appreciated asset, right? Whether it's Microsoft stock or your own business. If it's appreciated in value, you're selling it. If you donate it, you can avoid the cap gains and get a charitable deduction. So it's a big win-win. in the closely held business context, it's a lot more complicated and a lot trickier, and oftentimes you're going to need professional help from all three of us here in order to make sure you do it right, because there are some tax issues and even legal issues associated with that. Because what happens when the donation of the stock happens, the charity is actually now the shareholder, and you just need to make sure that's done in the right way, because there are legal and tax issues associated with that. So the next slide gives you an idea of kind of what the financial impact of that. Again, you're charitably inclined. You just know you want to give away X% of your company, right? You're gonna keep a Y%. You want to give away X%. Well, if you donate the stock beforehand, before the actual transaction takes place, you could, in this example of a $3 million transaction, provide over $700,000 more to the charity. And you get a bigger tax deduction as well. So the bottom line is, if you want to do something, and tax is generally not a motivation, there's just smart ways to do it. Next slide is, I would say, highlight some of those issues that do come up if you were to give a stock in a business that you own. So there is what's called an assignment of income doctrine. Basically, you need to put some time in between the donation of your stock to the charity and the eventual sale. So if it's something that is imminent, that's a consideration. If it's too imminent, then it may be something you can't do, and it may create more of a tax issue. So just something to be aware of there. Any asset that's non-cash that you donate, except for publicly traded stock, you need to report that in your tax return, and you might need to provide what's called a valuation report done by a qualified appraiser. So this is done on Form 8283. That's the second bullet here. So important point is, if you're gonna donate your private company stock, you actually need a valuation done to support that, because you have to attach that to your tax return. Giving the right way, whether it's a DAF, if that's even possible, or a private foundation, giving your private company stock to one of those vehicles is also a consideration. Again, that's why you kind of need, if you're interested in that, you need the right people to help you. And looks like that is it. Our last slide has our contact information, and we're all happy to stick around and answer any questions that you all have. And of course, you can always follow up with us via email.
Thank you all so much. So I'm just going to jump in with a few sort of burning questions that I had and that were previously submitted. But first and foremost, so there's a lot to unpack here. And I'm thinking a lot about the members that we're working with. And I'm just putting myself in their shoes. So say I'm a founder who's really passionate about a certain topic, but I don't have the time to sort of dig in and understand the best way to handle my non-cash assets and things like this. What's the best way to either connect with someone? What's the first step in figuring out how to do this, right? If I'm sitting here right now, assuming that I'm not going to go back through these slides and figure all of this out, what's the most appropriate first step? And I don't know, Rick, if you want to take this one, or if you've worked with anyone or have any sort of stories to tell, but this is just something that's burning in my mind.
I just send them to Rick is what I would do. Like literally, it would be, I would generally get that question a lot. I bet Melissa would too. And we would then point them to Rick. So, I pass on to Rick, but that's exactly what I would do. And Rick would be the best person to kind of kick that off, and probably Melissa as well.
Yeah. So Rick, what would that first conversation sound like, right? Is it an assessment of where they're at, what they're looking to do? I'd love to sort of hear your side of things.
Yeah, I'd say it's very open-ended. I mean, the thing I like about working at the Charitable Foundation is there's no agenda here. You sit down with somebody and you say, what is it that you've been trying to accomplish as a family or as an individual? What are you passionate about? As Pete said, it's not always led by the tax savings, but that can be a bonus. But the idea is just to keep a free-flowing, kind of open-ended conversation about values and impact and things like that. And then you start to construct something that feels like something they'd want to pursue. Would you teach us a little bit more about what's happening with the environment? Would you teach us a little bit more about what's happening with racial justice or with kids or veterans? And so we go back and we do a little research and we come back and say, here's what we suggest to you, and it starts to point people in the right direction. And then we start to formulate, well, maybe this is the type of fund you want to set up, or maybe you don't want to use the charitable foundation. Maybe you want to bypass us and give the money directly to the nonprofit, or there's all kinds of different options. But I like the consultative nature of what I do, in the sense that partnering with people like Pete and Melissa and others, we just put it all together for people. And then the satisfaction that I get and we get, I think, at the foundation, is to step back and go, it sounds like we helped this family, these individuals, do what they wanted to do. And you can feel it in the satisfaction in the conversations you have with people, that you feel like you did provide a nice service to them. So that's why I like the kind of the open-ended, free-flowing, let's have it go where the conversation goes, rather than feeling like we have a specific destination in mind.
And Melissa, I know that you're working with families experiencing sort of first generational wealth on a pretty regular basis. Are you noticing any trends, or is there anything that's unique to this group and their donation opportunities? Or are there some stories you can share there?
Yeah, definitely. So as you mentioned, we do work primarily with first generation families. So I think the last couple slides that Pete went over about the unique opportunities that group has in terms of private assets that they can give, and be smart about it from a tax standpoint. But I'd say beyond their assets, and beyond just kind of the ability to kind of go through the different structures that make sense, I think entrepreneurs are also unique in that they have a different kind of energy for solving problems. I mean, they've started businesses. They have gone through a bunch of problems through growing their business, and they've had some success. So I think as entrepreneurs or founders think about eventually an exit, and then what are they going to do with their lives? Often they're not sure. So if they pair it with something in the world that they feel passionate about trying to solve, and they're a little bit more used to risk than some other people, they are really, really well suited to try to solve kind of major items in the charitable world differently than other people, just because they're risk takers, they have energy, they are uniquely positioned. And sometimes it's not just with the dollars that they can contribute, but it's also with their time and the way that they think about the world. So that I think sets them up a bit differently. And it's fun. It's fun to see them, because once you feel like you've seen it all, you definitely haven't, because somebody will come up with something new that you haven't seen. So it's fun to work through.
And Pete, what about you? Have you seen any sort of common trends in the clients that you're working with that are looking to donate, or some pitfalls or sort of cautionary tales that we can lead with so people don't make the same mistakes?
Yeah, when I think when Rick and Melissa were talking, I think we all would love a client to just tell us what they were going to do a year or two ahead of time. And we could then structure something that was super efficient, that met their goals, and could plan everything accordingly. And the reality is that just doesn't happen. It doesn't happen as fast as we want. Sometimes it just doesn't happen because, hey, I got an amazing offer. So, and I can't pass it up. I got to take advantage of it. So sometimes that dictates what to do. So I had a client once that sold in December. It kind of came out of nowhere. And once we talked to them about, hey, this could be a huge income year, you should really think about charitable donation. It's super tax efficient, and they were charitably inclined. Private foundations probably off the table at that point because it's not enough time. So they contributed to a DAF, a donor advised fund, because it was, I don't even know where I want to send my money to a charity, like what charity to pick. And so we set up a DAF, contributed in the air, and then they can make those decisions later on. So the vehicle sometimes, is best suited, based on the timing. One of the things that I've seen a lot more recently is virtual currency. I've had clients that have made a lot of money in that, and they hear that there's tax issues, or they get scared now because they feel like the IRS is going to come after them. So they want to like just get rid of it. And that's really tricky because one, that's a non-publicly traded asset. And so you need to get a valuation done. As I said in my prior slides, you need to get a valuation done. Like who does a valuation of those is like, it's so new that there's not maybe a qualified person, and that person may be or not be sketchy. So that's an issue that I definitely have been seeing a lot more of.
I know that we don't have Josh on screen right now, but I'm sure he's probably jumping in his seat. And I think that you just potentially outlined a topic for another webinar. We've had a lot of inquiries and questions and interest and conversations around virtual currency and how that's going to sort of change the landscape. And I love that you said that the clients that you're working with really should have been thinking 1 to 2 years ahead of time. And I'm thinking about the startups that are in our network right now, that this is a long-term goal for them. But really, I think as an organization, we're recognizing that we need to sort of introduce this culture of the philanthropy a little bit earlier, right? It might be even more longer term than 1 to 2 years. So I guess, what piece of advice do you have, and from any of you, for people who are sitting here watching this and they may not be in a position to provide what they think is a meaningful sort of financial impact, but what advice do you have for the people who might not think they're there yet, or might not be there yet in a place to have that charitable impact?
I'll jump in if you want. So I'm a big believer, I think the three of us would agree on this, that the more you plan, the better. If you're just blue skying ideas or just sitting back and dreaming about what you think you want to do, I think that's a very important exercise, because I don't think you want to get to the point where there's an issue or an urgency and then you have to make decisions. It's better to sort of plan that out, somewhat in a, like I said, in a kind of a free-flowing way, and then you kind of work toward ideas that you're going to mull over, and you're having these conversations early. So if from a technical standpoint, you can say, well, what are the things I should be aware of? But also from a goal standpoint, what kind of impact do I want to make? I don't want to just come up with these ideas willy-nilly. I want to be able to put some serious thought into it. So I'm a big believer in doing it when there is no urgency. So even if you don't think there's anything right on the horizon, you never know. So wouldn't it be nice to have these things, these ideas sort of at least thought through or talked through with professionals who can help you do it without any particular urgency to get it done, but rather just to do it in a thoughtful way.
That's great advice. And I think the unique thing about our audience and entrepreneurs in general is this desire to problem solve. And if you could pair that desire to solve problems with a need, right, and be really thoughtful about that, there's so much potential for impact. So do any of you have any last words? And just so the audience knows, we are going to go back to the table setting. So we encourage all of you to turn your mic on and your camera. Both Pete, Rick, and Melissa will be seated at separate tables. So if you had a question that you have that you maybe weren't comfortable asking in a public setting, they have committed to stay behind to answer those questions. But before we break out into that, do any of you have some last closing remarks, any answers to questions that you think should have been asked? I'll turn it back over to you.
I just say there's no dumb questions, and no question too small. It's all a learning journey for so many people. The three of us have been doing this for a long time, but we respect the fact that other people have other areas of expertise, and this might not be one of them. So don't be afraid to come forward and ask any questions you like.
Great. And I did neglect one question in the Q&A, which was how low is the minimum account balance for a donor advised fund, and does this vary between charities?
Do you want to take that, Melissa? I could take it if you want.
Yeah, you go ahead. I know I think at like Fidelity it's like $2,500. I'm not sure what it is at New Hampshire Charitable, but it's pretty low. So you can speak to what you see.
Yeah, I think actually Fidelity just dropped their minimum to $0. Just happened not that long ago. Yeah, their minimum is $0. Ours is $25,000, And so the main difference there is obviously there's a $25,000 difference, but the other piece to that is something Melissa alluded to before, which is people who donate to a donor advised fund, say with Fidelity, it's very self-directed. And with us, it's more consultative and there's more interaction. So that's the difference besides the minimums. That's the main difference on why someone would choose a commercial donor advised fund over a charitable foundation like us, or vice versa.
Okay, great. All right, well, with that, we'll go back to the tables. Again, for those of you who are here and might have to jump off or want to go back to anything that we covered, this will be recorded, so feel free to go back and watch. So we'll see you guys at the tables. Thank you all so much.